Another day, another story. The impact of global macroeconomic variables on 2022. The year 2022 has posed a challenging investment climate, giving little space for maneuver for any financial professional. A pivotal year in history, 2022 will be characterized by environmental, geopolitical, and economic upheavals. Fighting off what was believed to be the pandemic's final phase suddenly turned into a full-fledged war. Here's a look back at global economics that have affected major asset classes in a cascading manner as 2022 comes to a close, highlighting stocks. The following worldwide macroeconomic issues disrupted the markets all year long. The effects of the Russia-Ukraine conflict on the world economy. The invasion of Ukraine by Russia on February 24 marked the start of the largest military confrontation in Europe since World War II. Although Russian President Vladimir Putin has had limited success rationally articulating his objectives for the attack, it is commonly believed that they are limited to the desire to conquer Ukraine and increase Russian territory. Whatever its origin, the battle had terrifying effects on the world economy. The West put economic sanctions on Russia in response to its aggressiveness in order to harm its economy. Restrictions like these include lowering Russia's imports of natural gas and oil. As a result, there was a lack of oil, which made inflation worse. Agriculture exports from Ukraine to other countries were hindered as a result of Russia's aggressiveness, pushing up the price of commodities. One of the biggest producers and exporters of agricultural products, including grains and oilseeds, is Ukraine. In addition, a number of nations and businesses with ties to Russia or Ukraine suffered. Investors thus changed to a flight to safety mode, bolstering the US dollar. The dollar had gained 12% against the euro, 9% against the pound, 16% against the yen, and 8% against the rand as of October. The underlying cause of investors' flight to safety is that U.S. assets are regarded as secure in unstable economic climates and may therefore be utilized for hedging. World inflation that is spiraling. The pandemic-induced global economic shock of 2020 spurred central banks all over the world to increase money injections into economies to boost demand recovery. It is hardly surprising that prices grew and inflation surpassed desired levels as demand increased. Inflation had a big impact on global supply networks in addition to domestic issues. The majority of central banks throughout the world started a campaign of monetary tightening in 2022 to combat the rampant consequences of historical inflation levels. This campaign was marked by strategic interest rate increases. The inflation rate in the U.S. is 8.2% year-over-year, compared to 10.1% in the Eurozone, 8.8% in the UK, and 7.78% in South Africa. The campaign of monetary tightening by central banks. The Federal Reserve increased interest rates by 25 basis points in March, 50 basis points in May, and 75 basis points in June as a response of U.S. inflation approaching 40-year highs. Fortunately, the U.S. inflation trajectory is starting to show indications of slowing down after peaking at 9.1% in June and declining to 8.2% in the most recent report. Despite the upward trend, one persistent aspect that defies the aggressive tone of the U.S. Federal Reserve is the labor market. The U.S. unemployment rate, which is now constant at 3.7%, is much over the anticipated levels, as are the monthly job additions and wage gains. The rate of disinflation can increase after the labor market is effectively slowed down because wage inflation is a significant component to overall inflation. Constant rate increases necessitate vigilance in order to prevent the economy from entering a recession, which would exacerbate issues with the socio-economic system. Increased inflation rates have a negative impact on stocks. The stock market saw unprecedented levels of agony throughout the year, with record-high sell-offs wiping out gains achieved in prior years, despite the deadly combination of interest rate hikes, decades-high runaway inflation, and a solid labor market, particularly in the U.S. The IT industry is foremost among them since it has been severely damaged and is particularly vulnerable to interest rate increases. The Nasdaq 100 index, which is heavily weighted toward technology, has down 32% year-to-date, showing just how far into the bear market the index has fallen. With high interest rates, equity valuations are substantially lower than their 10-year averages, and borrowing is more expensive for consumers and corporations, which slows economic development. China is important to the world economy. China, the second largest economy in the world, has been depleted by COVID-19 for 3 years in a row. Economic recovery has been impeded by a spike of COVID-19 cases in March, as well as strict lockdowns in various locations throughout that nation. Additionally, this had a severe adverse effect on the worldwide supply chain by clogging the ports of trading partners and causing unheard of delays. Furthermore, the U.S., which is already at conflict with China about chip supremacy, was hurt by China's military show in Taiwan to prevent Taiwan from allying with the U.S. As a result, the U.S. has stepped up its pressure on Chinese businesses in an effort to stop China from exploiting cutting-edge U.S. semiconductors to produce cutting-edge military technologies. Performance by sector. The S&P 500 has fallen 17% year-to-date due to macroeconomic uncertainty, geopolitical unrest, and a hawkish Fed, as mentioned above. Energy has been the best-performing sector, increasing by around 50% and largely offsetting the significant losses in other industries. In fact, practically every other sector has experienced a loss this year, with the exception of a few modest advances in the utility industry. Well, 2022 has created a challenging investing environment, leaving little room for any financial professional to negotiate the investment terrain. All investors are left with unanswered questions because, despite some hopeful developments in slowing down inflation in some parts of the world, the sticky dynamics that got us here still exist. These include inquiries like, has 2022 prepared us for a likely bearish 2023? What financial lessons can we draw from 2022? Given the Bank of Japan's change in policy earlier this week, would the U.S. Federal Reserve make a change in policy in 2023? Will things be better in 2023? This is still up in the air. Ideally, the Fed will achieve its goals for a soft landing, leading to at least some of the territory lost by equities in 2022. In spite of this, stay on the lookout for dead cat bounces, such as a potential Santa Claus rally near the end of the year. Carlos Slim Helu said, "With a good perspective on history, we can have a greater grasp of the past and present, and hence a clear vision of the future." With that in mind, thanks for watching.